You're listening to Across the Pond, a show about improving the lives of British expats living in America. Brought to you by Plan First Wealth.
Hi, Richard.
Hey, Tom.
How was your New Year? Have you recovered from the emotional strain that 2022 put on all of us investors?
I mean, I was at home for 11 days straight with a 7-month-old and a 3.5-year-old. It doesn't give you much opportunity to dwell. So I mentally recovered, but I'm mentally exhausted in a different way.
Okay. It just changed one set of stresses for the other then.
Yeah, which is not a bad thing necessarily.
No.
Gave that part of my brain time to recover, and now I've got my other part of my brain. Now they're back at school, so now I've got capacity to get stressed by the markets again.
Of course. So on that's what we'll go through today. Go through a bit of summary of the year. Got a few topics that we want to go through. Big picture though, last year was a tough year to be an investor, wasn't it?
It was brutal.
Everywhere.
It was exhausting.
Yeah. Everywhere was getting hammered. US stock market, Asia stock market, Europe, bonds. We'll talk about all this.
Yeah.
Yeah. Commodities. Could have put some money there, made some money last year, but wouldn't want to put too much money.
Now, yeah, I know people will say there was, because always looking back with hindsight, there was a hiding place. But the reality of it is, for most investors, there was no hiding place. The safe assets did not provide much safety.
No.
It was brutal, honestly. It was just, I don't think we'll have another... we'll talk about this, but I don't think we'll have another year like that in our investing lifetime. But that's what, every time, the global financial crisis, you won't have another one like that in our lifetime. The tech crunch, they won't have another one like that in our lifetime. It's always something. I always call it, there's a cross to bear. I think we'll touch on this later when we talk about bonds, but we had a cross to bear last year, and it was, for me, it was the everything going down at once.
Mm-hmm. I think a term used late in 2021, or throughout 2021, was the market was frothy. I think we lost all of that froth in 2022, and we're just sat with a black cup of coffee underneath it.
Yeah.
So what we'll do is we'll go through the main topics, try and weave in some rationale, some sort of understanding as to how this then sort of impacts investing. But we want to start with one of the main topics that I'm sure comes as no surprise: inflation. Started the year high, just over 7%.
But transitory.
Finished the year.
Right? It was
That was the
transitory
word.
still then in January.
It was. And there were some banks that were saying that people were putting too much emphasis on inflation and expecting some pretty stellar returns still last year. But that didn't happen. We peaked in June, 9%, but we are now trending in the right direction. We're back down at 7% now.
We're trending down, but you know what's particularly interesting? That the number the Fed looks at, and that we all, the number that comes out every month, that must be coming out pretty soon actually. That's the last year of inflation, right? But when you actually go and look at what's happening over the last quarter, you see it's trending down much quicker. So I think the impression I'm getting is that inflation is actually coming down quicker than it seems from the main number that we all pay attention to each month that comes from the government. It's coming down much quicker, which presents the Fed with a challenge, because they want a soft landing. But if they go too hard, they have a hard landing, and there are people saying, "Look, inflation's you've done your job. Like, just give it a minute." And they're kind of signaling, because they're what the stock market is going up, and they're signaling that you're making it worse for yourself, guys. Like, listen to what we're saying. We're not going to stop until this thing's defeated. So they've got to
stop spending. Yeah. Yeah, I'm keeping an eye on it. I've got a remortgage in June, so I'm hoping that the interest rates don't raise as quickly. And when I'm keeping an eye on this, and actually the forecasts are coming down now. Forecasts in the US are now lower than they were 6 months ago. So that is filtering through. But yeah, I mean, I think one thing that probably saved the inflation numbers last year was that wage increases were roughly 5 to 6% throughout the year. So actually, real inflation for people employed wasn't as bad as 9%. because your wages were going up 5 to 6%. Of course, that didn't happen everywhere. But we also found retirees, so Social Security went up considerably as well last year. So there was
it went up the most ever. I think maybe. Could be wrong there. I've just thrown that out there and now I'm questioning myself. But it went up a lot.
The UK state pension went up 10%, 10.1%. Wow. Social Security, I think, went something very similar.
8 something, I think. The triple lock in the UK, eh?
Yeah, it's staying.
10%.
I don't know how long for. Because no one else got 10% increases anywhere. But pensioners did, because they've got a great voting demographic.
Triple lock, by the way, for anyone wondering what that is, that's in one of our blogs about the state pension. So, if you're wondering, check it out.
So, inflation remained stubbornly high. So, what happened? What did the Fed need to do? They needed to blunt that. They needed to slow that.
I would just add to that, though, Tom. The impression I'm getting is the Fed's watching inflation and jobs.
Right, yeah.
New job creations, unemployment rates. The unemployment rate is like 3.5%. That's very, very, very low. And the spot we're in right now is inflation seems to be coming down, and I think/hope, if you look at the 3-month data rather than the 12-month data, it's coming down quite fast. It's the jobs numbers that is giving them some consternation now. Jobs are staying significantly. We're still posting strong new jobs each month. Unemployment rate has gone from 3.7 to 3.5. They want it to be over 4, I think. Are we going to see layoffs? Are we not? We've seen a lot in tech. Is that going to spill out into the wider economy? TBD. I think watch this space. I'm starting to look at the future, which we'll get to later, I guess. But that's now. I think is where the attention's going to start to turn.
Do you think that we'll see a reversal then? Obviously, the labour market's getting stronger and stronger and stronger. Every month we're adding new jobs. Do you see?
Yeah, but the rate being added is coming down, but it's still too high.
It's still 250, wasn't it? Around that number?
I think it was 220. The one that this week was 220. So it's still higher than pre-pandemic, but lower than it's been in the last few months, which is good. It's trending down, but is it enough?
So the Fed, as a result, have been raising interest rates. We started the year at 0%, would you believe? Which kept the housing market pretty buoyant. And we finished the year at 4.5%. So borrowing costs have gone through the roof. They've never raised interest rates this rapidly. They've gone higher, but they've never gone up this quickly.
Yeah.
So,
and they don't know what it's going to do. They don't know whether they don't know. No one knows what that means for this year.
No, they could. Yeah, because we could have avoided the soft landing. We might be getting
might be baked in already, right? It might be done.
Yeah,
but no one knows. And then you'd say, "Well, we'll take appropriate action." Well, no one knows. That's the problem. The Fed don't know.
No, they're just pulling a large string, and like the rational person is like, "Yeah, that should work." Yeah. But what are the consequences further on down the line? Because
the economy is too big, too complicated, too much going on to it's not predictable.
Yeah, because if you've got business owners today and for the last 6 months and the next 12 months at least putting off spending, you don't know how many people are now not going to be borrowing at 6%, which is probably what you actually get at the bank. If business owners think their business is going to grow at 7%, and the start of the year they could borrow at 0%, then it makes money. It makes sense to borrow money if your business is going to grow at 7%. But if interest rate's now at 6%, or the borrowing rate's going to be about 6%, people are not going to be borrowing. And how many people are going to stop those decisions? And then it only requires a small blip in the market for then layoffs to happen and the whole thing unravels. So,
well, we're seeing it in tech. It's about whether is it going to spread to the wider market. I don't know. I really don't know. If it does, then recession is inevitable, I think.
I think a lot of the banks are pricing in less of a recession. I don't know if that's the right term, but less of pricing in a recession than they were 3 months ago. It feels, when I've had to look at like the JP Morgan, the Goldman Sachs, like the reviews of the year, feels like less are pricing in a recession now. I mean, Goldman Sachs are 35% pricing in a recession for 2023. So I don't know whether the sentiment's changing yet, but I guess who really knows, as you said.
I get the impression that investor sentiment, I was looking at something here, investor sentiment is still overwhelmingly recession's coming. But then that itself is, when everyone is saying something, that's usually a sign to be on the other side of that trade. And I'm not even being facetious. That is really when everyone is saying something. Be very, as Warren Buffett says, be greedy when others are fearful, and fearful when others are greedy. If everyone is saying recession, and there's some other reasons why we might not have a recession, but the fact that everyone it seems to be saying that, point taken that some of the banks have very recently softened that stance.
Yeah. It's certainly happening in the UK and Europe, I would say. I think the US is still up for debate. I think the UK and Europe are going in. They believe it will be a mild recession, even still in the US and Europe, because they've managed to diversify imports from Russia quite quickly. So they think it will be a mild recession, at least at the moment. Today, January the 9th, that's what that's what people are saying. But yeah, so inflation is trying to be controlled by raising interest rates, and then for the investors like you and I that want their money to go up over time, they put money into asset classes like bonds and equities, and bonds this year have been hammered. They really have. Interest rates go up. We always get that yo-yoing where interest rates go up, bond prices fall. We have had that this year. The Global Aggregate Bond Fund, which is a index of global government corporate bonds, it was down 16% year to date, and that's your safe asset class historically, isn't it? Well, I put money into my bonds because they don't really go down. Well, this year they have, and they've fallen nearly as much as equities.
That's what hurt so much about this year is. Equity, I'm talking about the US here. Equities peak to trough 25% down. Less so, finished the year less than that, but 25% year to date. Peak to trough throughout the year. That's kind of almost garden variety. It's more than the average drawdown in a year, but for a bear market, it's nothing out of the ordinary. But what was so painful was that everyone's bond holdings were also down 15% There was no hiding place, and normally that's what you can point to as like a refuge, and it wasn't to be this year. And that's what I was saying earlier about this being, that was the cross to bear this year. In 2008, peak to trough, equities were down like 50%. That's brutal. But bonds were up. And that's how it normally works. Normally you can kind of point to that as your safety net. But when there's something especially disconcerting about both parts falling, even though the total wasn't as bad, 50% in stocks is just savage. But when another part of your portfolio is up, there's some comfort in that. But when everything is tanking, including the one that you've earmarked in your mental space for safety, it was terrible. And as I said, that I believe that was the cross to bear from this episode. Whether it's a recession or just a major bear market is TBD. But we'll look back and be like, every time you look back, you're like, oh yeah, that was particularly awful. In 2008, it was the housing collapse, the banking collapse, the stocks 50% down. In 2000, 2001, and 2002, it was tech stocks and the wider economy. And September the 11th, we will look back and it'd be like, that was brutal for stocks and bonds. And that was like, this is our cross to bear. We're not even talking about crypto. We don't do crypto. But I mean, that's a different side topic altogether that's been completely maimed.
Yeah, I think that's down 80% or something, which I think, and we're not advocating cryptocurrency in any way, shape, or form. I think that's quite standard for that in their 12-year history for falls of 80%. But yeah, it's commodities did okay last year. But do you want to put money? A lot of your assets that you want, your money that you want for retirement, let's say, you don't want to put that into commodities. You don't want to put it into the market that has got the industry that's got the biggest booms and busts historically.
I believe in putting it in real companies run by real people who have got profit motive and real assets that produce real income, and that's what I believe in.
Mm-hmm. So, and equities are a huge part of that. That's where you want. That's what will preserve your purchasing power by holding a lot of equities, global equities, in your portfolio. Last year, though, as you said, the US stock market down 18%. You diversify into Europe and Asia. You're down. Asia's down about 19%. Europe was down about 12%. The UK market was flat for the year. A few reasons there. Sterling. A weak sterling is actually quite good for the FTSE 100, and also the FTSE 100 holds a lot of those commodity-based companies, oil and gas companies. So that was flat, but yeah, global equities down a very similar number to bonds, and I think the safe place would, in hindsight, have been cash, but you move to cash and you sign yourself up for losses of 9%. If inflation's at 9%, so everything's getting more expensive, 9% a year, and you say, "I'll put it in cash," then that's going down technically 9% a year. It's it was a very difficult year, and one we want to probably forget at some point.
Yeah, don't throw the baby out with the bathwater, though, right? It was brutal in the moment. It was exhausting. On the back of 2020 was quite challenging, even though it was an up year in the end. 2018 we practically had a bear market at the end of 2018, but our job is to zoom out and look at the bigger picture, and the bigger picture is still what it has been for the last 200 years, according to the book I'm reading.
Okay.
Stocks for the long run. Stocks for the long run.
Okay.
Stocks, real assets, real companies run by real people are the driver of the most consistent driver of long term, after inflation, real returns. End of story.
Mm-hmm. Yeah, when you chart it back 100 years, not sure if your book might say different, but it's real companies, like you've said there, generate about 9% return. Inflation over that long period of time does about 3%. So that's the asset class to trust.
It's better than that. It's
Is
better. The real long-term real rate of return on stocks is, depending on what time frame you're looking at, varies between, I think it's 6.8 and 7.2%. Real. That's a real rate of return. Stock bonds are about half that.
Mm-hmm.
And bonds, the outlook for bonds is less rosy, given if you look back at what's happened in the last 40 years of a falling interest rate environment, and you look forward to the next 40 years, it's unlikely that bonds are going to be as attractive or generous as they have been.
But they're quite attractive today, would you say?
Mm-hmm.
I think the bond market down 16%, so you can buy things on sale, and yields are going up. So a position that we hold is down, similar 16%, and now yields 5-6%.
Mm-hmm.
So you should get the capital appreciation on the way up. So when that bond market bounces back, when that happens, and then you've got a pretty sizable yield, 5-6%. I think it's becoming a more attractive asset class than it was over the last 8-9 years.
Yield, definitely. I'm not sure about the bounce, but yield, definitely. Depends what happens with interest rates, I think. Whether you think interest rates are going to stabilize, go down, go up, and then go down. That it's very, interest rate policy is critical to what's going to happen with bonds. But to your point, the yields have gone up dramatically. So, and I do believe now they are a source of relative safety. By that I mean less volatility and attractive yields. So they've got a very important place in portfolios just for those reasons.
Mm-hmm.
But if you want long term, if you want returns, or if you need returns, real returns, it's equities. It's always been equities.
Mm-hmm.
Until
global equities or US equities?
Yeah, global equities. Yeah, global equities. Absolutely, yeah. It's and until our system of economic system changes, I don't see that changing.
Mm-hmm. Across the pond, the stock market did okay. It was flat. The bond market was actually down 25% in the UK. I'm talking about here. I know. Wow. I only found that out recently.
Wow.
Specifically UK gilts, down 25%.
Yeah. It tells you what the world thinks about the UK government right now.
Yeah. Part of that matrix last year, I guess the big story from the UK, at least for our clients, Brits in America, was what happened to their pounds. Their pounds coming in from their state pension, their pounds coming in from the defined benefit pension, their SIPs, whatever they've got. Liz Truss came in, if you remember her, and she brought out some bullish policies, didn't she?
That's one way of putting it. Poorly thought through.
The market didn't agree, did it?
No, I didn't.
I was a little bit worried, actually.
Mr. or Mrs. Market spoke.
Exactly. And they spoke to the tune of sterling falling considerably. And I was actually worried on that Friday whenever that happened. Can't remember now, September, October time. I think, don't hold me to this, it blipped down at 104. I think it closed that day at 108. And that is not a pretty picture for the UK because they import loads of stuff, most prominently like oil and gas, priced in dollars. So sterling going down to 108. UK has already got an inflation problem at like 10-ish%. Inflation looked like it was just going to go through the roof at that point. Then they have to raise interest rates even quicker, which slows the market down in the UK. I was a bit worried for the future of the UK for a few weeks there, and then it all got unravelled, and the PM's job got unravelled, and Rishi came to save the day.
Stepped in.
At least he's got a bit of more of a financial. Well, you hope that financial background is going to lend itself to some good policies.
I think he has.
So
I feel
far,
better
so
with
good.
his hand on the tiller.
I feel better at sterling dollar at 120.
Yeah.
When we're trying to run a business in dollars and we manage a lot of money in pounds, we've got a lot of exposure as a business. So we do keep an eye on it. We know we can't predict it. We don't try and play around with that in any way, shape or form, do we? Mm-mm. But it's something we keep an eye on because it impacts revenues and it impacts our clients. So it's a constant thing that we check in on and have conversations about. Okay, 2023. Maybe everyone's sick of 2022 and everyone knows what happened. That's a bit of a summary there of what we thought was sort of the hot topics of 2022. What was everyone talking about? 2023, that's what people care about more. So we talked a bit about it. A recession. Some banks are saying very likely. Some banks are saying unlikely. What do you think, Richard Taylor?
Well, I think all attention is about to turn to earnings.
Okay.
Profits. I still find it confusing when they call it earnings. I'm not sure I never called it earnings in the UK. I've called it profits. But profits, earnings is what drives stock prices. You have then overlay human behaviour on top of that, which is what causes all the massive volatility. But last year was all about inflation. I think this year the topic is going to be about earnings. That's about to start this week.
So what's earnings?
Profits.
Okay.
What profits are these businesses reporting from last year and what they're projecting, and how that's going to affect the prices of the stock prices. So I think that's of critical importance now, and with the caveat that you just never know. And if you want to know what a mug's game predicting is, just look at what all the banks predicted for last year at the start of the year, and and these are the cleverest, sharpest people with the best research and the best access to experts and stuff, and they got it so hideously and hopelessly wrong. It's a mug's game, but let's play it. If you just look at the economics, it seems impossible to me that we will avoid a recession. When you look at, I don't think inflation's ever been quelled when it got above 5% without a recession. When you talk about things like interest rates, when you just look at all the factors together, How would you avoid? It's just I don't see how you would avoid a recession. But then, last year was brutal, and it might already have been dealt with. Usually, a market bottoms out early in a recession, and if we're not in a recession, that would suggest it's further to go. But then there's other things. So we're entering into the third year of a presidential cycle. Historically, this is the best year for the stock market. I could be wrong here, but I'm pretty confident in saying I don't think there's ever been a recession start in the third year of a presidential cycle. So there's always the first time, but today I don't think a recession has ever started in the third year. And historically, the third year is the best year, and we're already significantly down. And people would say, yeah, but you have to be. A recession usually invites a 30 to 35% drop in the stock market, and we've only had a 25% drop. But maybe this time is different, and that's very dangerous words in investing. But maybe this time, the fact that we also had a 16% drop in fixed income at the same time, maybe that, because as I keep saying, that's across the bear, maybe that's our equivalent of a 35% drop in stock. It may or may not be. We just don't know. But maybe it was so bad on that level that kind of compensates for the market not going down far enough. Then there's also, hold on, this is really interesting, I thought. So, the S&P fell by 19.4% last year to year. 1st of Jan to 30th of December or 31st, so market closed on the 30th, 19.4%, right? So, historically, when the market is down by 10% or more, the next year there's a 63.6% chance of it being up, right? So we fell by more than 10%, therefore, historically, chances of it being up this year is 63.6%. Get this. When it's fallen by 20% or more, 100%. And we were 0.6 off. Now, you can read too much into these things.
Yeah.
But what does that mean? If there's a sliding, if there's a sliding scale, does that mean there's a higher chance? I mean, the 63.6% isn't that great odds. 90% plus is great odds. And there's just and then we go back to what we said before. Maybe not everyone now, Goldman Sachs, but everyone was predicting a recession. And when everyone is predicting a recession, that tells you, oh, maybe I should be on the other side of this. And so I absolutely, the logical case, having followed this last year and watched the numbers and understanding what's going on with interest rates and inflation historically, how is it not a recession? But then when I look at these other factors, and I wonder what's already priced in, I do think there's a chance we don't have a recession, or the worst is behind us. I hope that's the case. For long-term, multi-decade investors who have got an appropriate portfolio and asset allocation and all that stuff, it doesn't matter, or it shouldn't matter. That sounds a bit glib, because it does matter, because it messes with us. It messes with our heads. Especially if you're in retirement or approaching retirement, it really does. But that's why it's the importance of having a plan and appropriate asset allocation. But what do you think?
Well, I was gonna ask you a follow-up question actually. So you're listening as someone today pre-retirement. You're hearing Richard Taylor, maybe he's your advisor, and he's saying that there's a likely chance there's a recession. So what does that mean? Would you if you think there's likely to be a recession, should you not just try and manage around that and go to cash?
Well, what I'd say is, for a start, if you're approaching retirement, great. Recessions are a part of the business cycle. We're never going to, as long as we remain human, I don't think there's a chance we're ever going to overcome that. Poorly managed, recessions and market corrections can be utterly devastating to retirement plans and long-term wealth. But if you can get a recession out of the way before you retire, and you can make sure it doesn't affect your finances negatively, selling out when it's down, yada, yada, yada. But if you perfect. I would say the best time to go into retirement is having just been through a recession. The worst time is just before a recession and unprepared for it. All we can do as planners is you know that bear markets and recessions, sometimes prolonged, are a part and parcel of long-term investing. So what you do is you build a plan with those things in mind. You build an asset allocation plan with those things in mind, so that when they happen, clients have sufficient resources to not commit some of the errors that can devastate a plan. Selling equity when it's down, or hasn't had a chance to recover, that kind of thing. But we don't need volatility is part and parcel. But the volatility is why we get the long-term returns. We should work around it rather than try to pretend it doesn't exist. I watched the Madoff documentary at the weekend. When you try and it's trying to magic it away that we get the problems.
Right. Okay.
Working with it and harnessing its power, whilst also having the guardrails to avoid the mistakes. We believe that's how you do it. And then what is it we say? Economy cannot be consistently forecast. Markets cannot be consistently timed. Therefore, the only way to capture the permanent return of equities is to sit through the temporary declines. That's what this is. But you need a plan. I'm not saying we need to do the plan for you, but you need a plan for your assets and your financial plan, retirement plan.
Mm-hmm. I haven't heard of any retirement plans that have been ruined by staying invested and staying committed. We have heard people's retirement plans be ruined by trying to time and going to cash like 2-3 years ago when COVID happened, when it made total logical sense to say the economies around the world are closing down. Everyone is being told to stay at home. I'm going to pull my money out of the market. It's already down 15-20%. I'm going to jump on that and go to cash, because cash is safe. It's a number. I know it. Yep. It's not going to go anywhere.
The illusion of safety.
The illusion of safety, because it actually isn't that safe. But and
then when do you get back in? So what happened there is I heard exactly the same thing. I know of people who, not our clients, people who went to cash and then the market ricocheted back. I think it's safe to use that term there. And then when do you get back in? Then you're waiting for it to collapse again, and it goes up and up and up. And now it has come back down, but what usually happens is people get in too high. Yeah, it's just that's how you destroy wealth, in our opinion.
Yeah. So don't make any rash decisions, despite what you've heard on today's podcast. No. So it's 2023. As every year passed, we've written about markets for years and years. The same sort of thing happens. There's huge stories. There's huge things and reasons to sell and to panic and to do something with your assets. And 2023 will be no different. We don't know ultimately how that will result.
I think we have a big emotional bonus going into this year. Is that last year took everyone by surprise. This year, everyone's going in apprehensive at best, and that just means that there's more chance we'll be surprised. I think to the upside, even if it's not a good year, because we've all got such low expectations and there's such significant concerns and worries. It won't take much for us to be like, oh, that wasn't too bad.
As you say, like it being on the other side of the bet, the other side of it, what everyone else is saying, we might actually get a more optimistic year. I would agree with that. I'm aligned on that. I think that's what we could get this year. Is not a recession. Potentially, maybe we just avoid it. Maybe we get a small one, 6 months, and then we get a bit more confidence back in the market. People start spending, and all of a sudden we're up 10-15% by the end of the year.
This is just not 2008, and. That was my first recession, really, that I remember working. It was awful. It was brutal. People were losing their houses. The financial system nearly collapsed. There's been excess. We've had low interest rates for years. Tech's got a bit carried away. But FTX blowing up is not the same as Madoff blowing up, which was Brothers. Not blowing up. Sorry, that was a Ponzi scheme. But this is not this is not fun. This is not nice. I've not enjoyed it. But this is not 2007, 2008. In some ways, it's prolonging it because the households are in such better shape as a result. They went into 2008 over-leveraged and no savings. And so everyone just capitulated the moment everything turned. Whereas going into this, they've got more money from having more savings, and the government threw a load of money at them from COVID. And that's what's kept consumer spending so high, which has caused the Fed to have to keep putting rates up to fight it. So it's prolonged it a little bit, but 2007, 2008, 2009 was within the scheme of things relatively short, but it was savage. Whereas this, I think, it could be the pain could be prolonged slightly, but much shallower and with much fewer consequences for people. People were losing their houses and stuff really got messed up in 2007, 2008. I don't think that's going to be the case here. Certainly, it's not been so far, and it's showing no sign of it. It's uncomfortable. It's unpleasant. It's not nice. It's not the precipice of economic destruction that we seem to go to in 2008, and we did. I remember the day Lehman went down. I remember where I was.
Where were you?
And then everything. Well, I was at home when I found out. But I remember being in the office and not truly not quite grasping how bad it was.
No, I don't know if anyone could have done really. Well, but I'm sure some people
you
did.
knew it was bad,
yeah.
but and then 6 months later the market bottomed out, and here we are, 14 years later.
So keep an eye on employment numbers, earnings. That dictates inflation, interest rates. Stay invested. Don't make any rash decisions. And tune in when we do our podcasts. That'll be the only other thing I'd add to that this year, which we're going to up. We're going to be doing a few more podcasts this year. So stay tuned. If you want to know more about us, and if you're a Brit in America, then go onto our website, planfirstwealth.com. But also we have a Facebook community for Brits in America called the Plan First Wealth Hub, and we'd love to see you in it. Thanks for listening to this episode of Across the Pond. This podcast is brought to you by Plan First Wealth. For more information about Plan First Wealth and Across the Pond, visit us at planfirstwealth.com. If you like this episode, consider sharing it with fellow Brits across the US. You can subscribe to future episodes in Apple Podcasts, Spotify, or wherever you listen to your podcasts. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.